So good morning to everybody. Thank you very much for being here. Maybe we wait for a few minutes more and then we start, okay? We wait more 1 or 2 minutes and then we start. Thank you. So it's time to start. Thank you very much for being with us today. Welcome to the international webinar on blockchain and cryptocurrencies. First of all, I would like to thank you for having accepted to participate in this event. It is an honor to count on you either as a speaker or as a participator. This event is co-organized by Universidade Autónoma de Lisboa, which I represent, also by Instituto Superior de Ciências Policiais e Segurança Interna, ISCSI, and by the European Union Agency for Law Enforcement Training, CIPOL. We have today, in this webinar, we have 4 talks. The first talk will be mine, Support Technologies and Future Trends of Blockchain and Cryptocurrencies. Then we have the well-known Professor João Duque, with the title of the talk is Cryptocurrencies and Crypto Assets. The third talk will be given by Nuno Almeida from Ernst & Young, Value Chain Transparency Enabled by Blockchain. And finally, we have the representative of the European Union Agency for Law Enforcement Training, Jorut Stoica, with the title of the talk, Law Enforcement Training on Cryptocurrencies. So, kindly note that this event is fully online in English, and the talks are limited to 35 minutes, followed by 5 minutes for questions and answers. So this event is being simultaneously transmitted through Zoom and YouTube. Thank you for your participation. And now I transfer the floor to Intendente Roberto Fernandes from Instituto Superior de Ciências Policiais e Segurança Interna, who will give some welcome words. Thank you very much.
Many thanks, Professor Mario. On behalf of Police Research Center, I start by thanking you, Professor Mario, for launching us the challenge to co-organize this seminar, which we gladly accepted. I also thank our speakers for accepting our invitation, and especially CIPOL Cybercrime Academy for gracing us with their support. Once again, good morning to all of those who joined us in this debate on one of the hottest topics of today, after the crash of the Earth systems, already called as the Lehman Brothers moment of cryptocurrencies. The value of lunar cryptocurrency went from 20 billion to almost 0 in 24 hours in a crash that is hard to explain. Despite the recent Bitcoin crash and the Luna and the USD debacle, cryptocurrency markets are increasingly correlated with the stock market. Indeed, cryptocurrency prices fall when stocks fail, which in return are strongly affected by macroeconomic factors. On the other hand, as it is a profitable and booming instrument in the global geoeconomic area, cryptocurrency has attracted the attention and the interest of powerful economic conglomerates and even transnational organized crime, which raises concerns about misappropriation. I look forward to hearing the perspectives of our speakers, so I will pass the stage to them right now, and good work to all of you. Thank you.
Thank you very much, Intendant Roberto Fernandes. So I will start my own presentation, the first presentation, which is entitled Support Technologies and Future Trends of Blockchain and Cryptocurrencies. So my name is Mário Marques Silva, a professor at the Universidade Autónoma de Lisboa, and I will read briefly my short biography in a minute. So I'm an associate professor at the Universidade Autónoma de Lisboa and the director of the Department of Engineering and Computer Sciences at the same university. I'm a researcher, also researcher at the Instituto de Telecomunicações in Lisbon, Portugal. Between 2005 and 2008, I was with NATO Air Command and Control Management Agency in Brussels, where I managed the implementation of the deployable communications of the new air command and control system. I've been involved in multiple computer networks and telecommunications projects. My research interests include networking, mobile communications, network security, namely transmission techniques associated with 5G and 6G communications. I'm author of 5 books from CRC Press and author of several dozens of journals and conference papers. So the outline of my presentation, we have initially the introduction, then I will address the Bitcoin, the blockchain, and finally the mining issues. So with the development and the massive use of the internet, there is a need for a currency with the same requirements, something that is global and instantaneous. So global means borderless, without borders, and something that we can transfer or make payments at an international level and without delays. This was the main motivation to have or for the development of the cryptocurrencies that's, let's say, facing an explosion of usage nowadays. We see that many countries, even Europe and the States, are using more and more payments and transfers based on cryptocurrencies, where the Bitcoin is the mostly known cryptocurrency. It is the dinosaur of the cryptocurrencies. Moreover, the cryptocurrencies are aimed to be decentralized and secure. Decentralized means that there is no need to have banks or governments in the middle. So in addition, decentralized means also that they are not server-oriented, but they are peer-to-peer oriented. Peer-to-peer oriented means that the transfers are made directly between different computers of users. Moreover, these transfers are secure, are aimed to be secure. That's why it's called cryptocurrencies. Cryptocurrencies means that this is a currency that is encrypted. Encrypted, it's secure because it gives us protection from attacks using digital signature. It protects from attacks against the authenticity, integrity, and avoids the non-repudiation. Authenticity means that the author is the legitimate author. There is no one that tries to act as a third party. Integrity means that the data is not altered, is not modified in the middle. Moreover, non-repudiation means that a certain person that carries out a certain action does not deny such action in the future. For example, if I implement bank transfer, I cannot in the future deny that I was the author of such bank transfer. So non-repudiation is something, so being a cryptocurrency, utilizing a digital signature, we protect such currencies from attacks the authenticity, integrity, and avoiding non-repudiation. So such security are implemented not only with the digital signature, but also with the use of a blockchain. Blockchain means that we have a chain of blocks where each block has, let's say, is registered the events that were, or the transfers that were implemented in the last 10 minutes. And a chain of blocks means that the different blocks are linked, there is a chain that links the different blocks. This gives security, this makes the information trustful. And due to the blockchain, with following a decentralized approach and a trustful or secure approach, is the future of the internet. The Web 3.0 is expected to be implemented using blockchain, using a decentralized approach, that is, instead of using a server-oriented approach, it will use a peer-to-peer approach. Moreover, everything will be secure, will be digitally signed, such that we will know the author of any information that will be available on the Web 3.0. Moreover, blockchain will be massively will be used more and more in the future. For example, let's say in insurance, in different companies to perform, to allow the reliable audits to be implemented. For example, in aviation, let's say there is an accident. Okay, we have these black boxes that register everything, but sometimes they fail, and this is not completely digital. So the future, the blockchain allows registering all of the events. It can be viewed as events logbook, let's say, where everything is registered without the possibility of modification of data that was previously registered. So the Bitcoin is a smart currency designed to be evolved by smart engineers. It eliminates the need for banks, frees you from credit card fees, exchange fees, wire transfer fees, and reduces the need for lawyers and juries in transactions, all good things. So this is a statement that was given by Peter Diamandis, founder and president of X Prize Foundation. So it eliminates the need for banks because this is decentralized instead of following a centralized approach. So it follows the peer-to-peer approach, and exchange fees, since there are no banks in the middle, we reduce a number of fees, and we speak about an international currency. So, for example, if I want to make a payment, I want to purchase any product in China, for example, if I want to pay with euros, there is a transfer an exchange fee from euro to a yuan, and we lose some money in this exchange. With a global currency, the aim is not to lose money and to have something that is instantaneous. Okay. Moreover, reduces the need for lawyers and juries in transactions. Why? Because with the blockchain, we have every information is registered without the possibility of non-repudiation. So there is no possibility for any party to deny that such action was undertaken. So just to mention that the CEO of Binance, one exchange of cryptocurrencies, Mr. Changpeng Zhao, owing 96 billions of US dollars, is suddenly he became the 11th richest man in the world. So Bitcoin is the mostly known cryptocurrency. Is the dinosaur, is the first one, was created by Satoshi Nakamoto. As I mentioned, it follows a decentralized and without intermediaries. There are no governments or banks in the middle. It's a global currency, like most of the cryptocurrencies. Well, in fact, for example, European Union and several governments are studying the implementation of cryptocurrencies. Okay, even the European Union is right now studying such implementation. Nevertheless, we lose the globality, the borderless point of view. So without intermediaries, the transfers are immediate, let's say in 10 minutes, which is the time that we need to process one of the blocks of the blockchain, 10 minutes. So it's faster, transfers are faster, more private than fiat currency. Fiat currency is conventional government currency that I will address in a minute. So we use Bitcoins and cryptocurrencies for payments, for investments, for shopping. Nevertheless, many people look at cryptocurrencies only as an investment of stock market type, and this is, from my point of view, this is not exactly the main purpose of the cryptocurrencies. As I mentioned, blockchain technology allows peer-to-peer transfers. It makes use of computer networks instead of servers. So the Bitcoin, speaking a little bit about the Bitcoin, this is limited to 21 millions, while, for example, the fiat money, the conventional government money, is completely unlimited. For example, we see that the United States or Europeans or different governments, they can power on the printers, and we see that the people that have savings, there is a devaluation of the money of people. Moreover, transfers of cryptocurrencies are realized 24/7. For example, the transfers of conventional fiat money, for example, international transfers are performed during duty days, not during the weekends, and normally it takes 24 hours. Moreover, the Bitcoin transfers are pseudonyms, not anonyms, where anyone have access to each block of the blockchain of the Bitcoin, and we see that the transfer was performed from A to B. We don't know exactly who is A or who is B, but we know that the transaction of the amount of X was performed between person A to person B. This is anyone that is on the blockchain of Bitcoin have access to this. Moreover, let's say around 30% of the persons worldwide are unable to have conventional bank account, which makes the cryptocurrencies useful. What is fiat money? Fiat money is a government issue currency that is not defined by a physical commodity such as gold or silver. Initially, the the coins were made of gold or silver, and the value of the coins was the value of the gold or the value of the silver. Nowadays, there is no the amount of money that is circulating does not correspond to the amount or to the value of the gold that the central banks have. There is no such link anymore. So a government can, or the European Union can print more money without a mapping to the value of the gold that are in central banks, causing what? Causing inflation, devaluation of money, and namely people with savings lose money. So the difference between the fiat money and the Bitcoin. So the fiat is unlimited reserve of value, more can be printed at any time. The Bitcoin is limited. There is a maximum of 21 million Bitcoins, or there will be, not right now, as I will explain in the following, but there is a maximum limit of 21 million Bitcoins in the world. For example, other currencies are unlimited. For example, the Ethereum is unlimited. Bitcoin is limited to, or will be limited to 21 million. The fiat currency is influenced by interest, or can be influenced by interests of stakeholders, for example, governments and banks. So there are some privileged stakeholders, let's say, where in the cryptocurrency, all stakeholders are equal. Expensive transfers from fiat money, because banks have some charges associated, while the cryptocurrencies are low cost, direct person to person, without intermediaries, so it's less expensive, almost free. So the transfers of fiat money are slow and bureaucratic. For example, international transfers can take up to 48 hours, while the cryptocurrencies transfers are processed at the speed of the blockchain, are almost instantaneous. Namely, they take 10 minutes, which is the time to process one block, as we will see in the following, and such processes are performed 24/7. So right now we see here the value of the Bitcoin. We can see that the Bitcoin value has decreased in the last 6 months. We can see here that we have Professor João Duque will explain much better than me, but we see that we have typically 4 or 5 years of expansion of the global economy, and then we follow a period of contraction. We have already started such contraction period, and during this contraction period, we experience a fall of the stock markets, a fall of the cryptocurrencies, an increase of the inflation, a devaluation of the money, an increase of the unemployment, an increase of savings. People start saving money because interests are higher and it's more risky to invest, and the leveling of investment decreases because the profit of the companies decreases during this contraction period. So this is the reason mainly. This is the reason why the Bitcoin, the value of the Bitcoin was almost 6 months ago was almost more than 50,000 euros each Bitcoin, and right now the value is 28,000 euros. Now, how can we acquire Bitcoins? 3 ways for us to acquire Bitcoins. Buying Bitcoins, for example, we go to an exchange like Coinbase or Binance, or we sell something and we accept Bitcoins. For example, I can sell an apartment and accept such payment in cryptocurrency. Or I can perform mining of Bitcoins. I will speak about mining when the miners will be rewarded with Bitcoins. And I can perform mining individually or in pool. Normally, mining, to be more efficient, is performed in pool. So mining means processing power, computer processing power, and such users are rewarded with some Bitcoins. This is the third way of earning Bitcoins. The Bitcoin, there are three different codes that we Bitcoin users have. The first one is the Bitcoin address, is like a bank account, and there is a private key and there is a public key. The private key is kept secret by its owner, and the public key is widely distributed. The public keys can be like an IBAN of a bank account, let's say, and the Bitcoin address is a reduced version of the public key, but cannot be generated from that. Speaking about, we are speaking about cryptocurrencies, so I will address what is what is cryptography. In cryptography, for example, in the military, we have normally there are symmetric ciphers or symmetric encryption, while we use the same key to cipher and to decipher. For example, every day we have a cipher, we have a key which is widely distributed among, let's say, among NATO countries. And such key is used to cipher and decipher the messages. This is symmetric encryption. What is the vulnerability associated to such key? The vulnerability is that during such distribution or during such wide distribution, we may have people that are not legitimate people that have access to this. To mitigate this, there is it was invented the asymmetric encryption. Well, we have two different keys. We have a public key and a private key. If the sender wants to send a message to the recipient, the message will be ciphered with the public key of the recipient, and the message is encrypted, already encrypted, is transmitted and received, and then the ciphered message is deciphered by the private key of the recipient. So the private key is kept secret by the parties, while the public key is widely distributed, such that it is possible for the senders to cipher the message with the public key of the recipient. So this is the asymmetric ciphers. Let's say about hash functions. When we speak about digital signature, we speak about a function widely known, which is hash function. Hash function is like a digital signature. In Bitcoin, we use the SHA-256, while from a text we apply the hash function. We have a total of 56 bits, and we send the digital signature is this. I send the message alongside with such signature, with such 256 bits together, and the recipient receives the message, applies the same hash function, and verifies that the hash sum, which is the 256 bits, are the same as those that were transmitted alongside with the message. Now, we have a problem. What about if someone in the middle intercepts the message and the hash sum and modifies both? To avoid this, we have invented the digital signature. The digital signature is an improved version of what I have explained before. The digital signature avoids integrity, authenticity, and avoids non-repudiation. So we have the message, we apply the hash function, the SHA-256, and we cipher. I'm going to cipher the message or the hash sum. I'm going to cipher the hash sum with my private key, and I send the message alongside with the hash function. But in this case, I send with the hash function is ciphered with my private key, such that no one can modify the message or the hash sum. Or if in case such modification is performed, the receiver will detect it. Now, I'm going to send the message and the hash sum, and the recipient will receive both. In case the message and the hash sum was not modified, or before, the recipient performs the hash function, applies the hash function to the received message, and generates 256, which is the hash sum, and compares with the hash sum that was received after being deciphered with the public key of the sender. If such comparison is the same, then the integrity and authenticity is assured. This is the digital signature, okay, which is widely used in the blockchain. So to perform a transaction, 3 elements are involved: transaction sender's private key, a public key, and a transaction amount. There is also it should be mentioned that there is in case the owner of the cryptocurrency loses the private key, the public key, and the Bitcoin address, then he loses the funds. So it's widely important to keep the keys, such keys, widely well secured. In order to, because there is no possibility to go to my bank and ask for my credentials to gain access to my funds again. There is also the 12-word phrase, also known as seed phrase, that allows the retrieval to all wallet private key and Bitcoin addresses, allowing recovering to access to funds even in the event of losing access to our original wallet. So about the blockchain. The blockchain is a chain of blocks, which, as I mentioned, it's secure and decentralized. It's peer-to-peer instead of server-oriented. It's secure because it uses digital signature, so the information is trustful. As I mentioned, Web 3.0 will be based on blockchain. Why? Because all of the events are registered and everything is recorded, following timestamps, what was done by who and when, and everything is stamped without the possibility of modification, of alteration. So everything is digitally signed, and as I mentioned, integrity, authenticity, and and avoiding non-repudiation. So when we speak about the blockchain, we speak about a chain of blocks. So we have a block, and we have another block, and we have another block. One block, one block, one block. And all of the blocks are linked together. This is why it's a blockchain. And we have this block as a content. In terms of Bitcoin, this corresponds, such content corresponds to the bank transfers that were carried out during the last 10 minutes. All of the transfers from A to B, from C to D, all of the transfers that were carried out during the last 10 minutes. And such block is digitally signed with the hash sum. How to link these blocks? The following block has the previous hash as the content and also has a previous hash. A previous hash should be equal to the hash of the previous block. That's the way such blocks are linked together. This is why this is called blockchain, a chain of blocks. And the chain is implemented by using the same hash in different blocks. This is the hash of the current block, and this is the previous hash. Okay? For an hacker to modify everything, all of the, let's say, the transfers, a hacker would have to modify this hash. So a hacker would like to modify the content and would have to modify the hash sum, and would have to modify this hash as well, and would have to modify this hash as well, and the following hash, and all of the hashes are in the chain after a certain block. And this is computationally impossible because each block is subject to a proof of work, which is computationally demanding. And this is very demanding to perform the mining or the proof of work of each block, and it's completely impossible to perform such actions in different blocks. It's very demanding to do it in one block, and it would be computationally impossible to modify all of the different blocks in the blockchain. So we have different hashes. Each transfer, as I mentioned, each block has the bank transfers performed during the last 10 minutes, and each transfer has a certain hash, which is the digital signature of such transfer. Moreover, each block also have an hash subject to an hash, which is called the Merkle root or root hash. So each block of the blockchain of the Bitcoin has 4 different fields. As the data, which is a set of transactions included in these blocks, namely the transfers carried out in the last 10 minutes, the hash sum, and the previous hash, which performs the link. And finally, there is a new field called nonce. The nonce corresponds to a random value which is used to vary the hash sum output. I will explain the importance of this field, the nonce, in a minute. So the blockchain was created much before the Bitcoin. It was created in 1991 in order to have the data organized in a sequential and secure way to prevent alteration, modification of documents, events, or modification of data. So everything you do is recorded and avoids non-repudiation, and it opens up disruptive prospects for the future smart contracts. Everything can be done without the possibility of non-repudiation. Blockchain can be used in business world, for example, in insurance, aviation, to allow edits to be carried out. For example, reliable electronic voting is expected to be implemented using also blockchain technology. The Web 3.0 will be implemented based on blockchain. Why? Because it's trustful, and it will follow a decentralized approach, that is a peer-to-peer approach, using only our computers instead of using servers where all of the information is stored. Moreover, in terms of network security, blockchain also have advantages because it identifies what was done when and by whom. Just Mr. Lex Sokolin, the head economist for Consensus, as mentioned, corporations are still only just figuring out the potential applications of blockchain technology, but its use is already growing more quickly than anyone could have predicted. So I have already mentioned that for a hacker to modify or to attack a block, he would have to attack a certain block and modify the hash and all of the hashes after such block, which is computationally impossible. No one has succeeded until today. What is mining? Mining is the computer processing required to perform the proof of work. What is the proof of work? The proof of work is the validation of a block of the blockchain that is performed, is a way to validate one block. Let's think about the one block of the blockchain. As I mentioned, one block of the blockchain as the bank transfers that were implemented in the last 10 minutes. And we need to validate such, we need to a process to validate that such transactions were really implemented. How do we perform such validation? We have different approaches. The approach that is widely followed is the proof of work. The proof of work, we have a nonce. I already mentioned a nonce, which is a random sequence, and I perform. I calculate I apply the hash function, and I generate the so-called 256 bits hash sum, and such hash sum should be lower than a certain target. So this is computationally demanding. What is done during mining is what we have here. We have a block, and we calculate the hash of this block, and we calculate the hash with a certain nonce, which is a certain sequence of random characters. And then I verify if such hash value that I have obtained is lower than a certain predefined condition, lower than a certain hash, let's say. If not, I modify the nonce again, which is such random characters, and I perform this billions of times until the hash value is less than a certain predefined condition. This is why this is called the proof of work, and computationally this is performed with mining. This is the process of validating one block. And you ask, but why is it so complex? This is very complex to avoid a hacker to modify this. This is why this is very demanding. This is very computationally demanding. Okay. So we have the hash target, which is becoming lower and lower, is changing every 216 blocks, and it's becoming, the level of difficulty of mining is increasing every 216 blocks. So since 2010, the level of difficulty has increased a lot. Okay, why? Because mining, because the predefined condition has decreased its value. So it's becoming more and more complex. So initially, we used to perform the mining with CPUs, central processing units. Then we started using graphical processing units. Nevertheless, the level of energy consumption has increased a lot. It became exaggerated. So nowadays, in the Bitcoin world, or in the blockchain of Bitcoin, we started using ASIC technology, application-specific integrated circuits, which are, instead of being multi-purpose circuits, they are let's say, specific circuits for certain purposes. Nevertheless, it consumes less power, but it's very noisy and subject to heating. So the miners are using nowadays ASIC technology, and they are rewarded. They are rewarded. They receive nowadays. They receive every time, when each block of the blockchain is validated by the miners receive 6.25 bitcoins, okay, which is halved every 4 years. So the technology available in the market for mining, we have the Antminer S19 Pro, which performs 110 trillions of hashes per second. This iterative process of modifying the nonce and calculating the new hash. And people get money. People right now in the world is investing money or is being rewarded with bitcoins, and people is investing in mining to be rewarded and to gain bitcoins. This is a way we can get bitcoins. Nevertheless, the level of energy consumption is very high, 3 kilowatts, around 3 kilowatts. Okay, mining can be done in two different ways, individually, but it's almost impossible for an individual to perform the mining and to validate one block, or in pool, which increases the probability of success using distributed computing. Now, as we saw, the mining process is very computationally demanding, and so the process, there are other validation processes, alternatives to the proof of work. Instead of the proof of work, which is computationally carried out using mining, there are two different other approaches. One is the proof of stake, and the other one is the proof of stake authority. The proof of stake is the process of validation, where using validators, users or the computer of users act as validators of blocks. Each block is validated by a certain user from the software point of view. The computer software will validate such block and will calculate the hash function instead of this computationally processing of mining. Okay, and these such validators are randomly selected from the universe of the users, the blockchain users. The other approach is to have certain super nodes with special privileges, and these super nodes are the validators. This is the so-called proof of stake authority. Nevertheless, in this approach, there is the risk that these super nodes or super users, they can eventually perform an agreement, and in order to defend their interests, the interests of such stakeholders. And then we are approaching the conventional centralized system used by banks. So we lose in some way, we'll use some of the advantage of the democracy of the cryptocurrencies. So this is a block of a blockchain. Anyone can have access to this, to a block which includes all of the transfers performed in the last 10 minutes. We have, for example, this transfer, which was carried out by a certain user, and such transfer, this is the destination of this transfer, and this is the fee that was taken from such transfer. Okay, this is a transfer of 0.299 bitcoins that were sent to this user. We don't know exactly this identification. That's why we say that the transfers, the Bitcoin transfers, are pseudonyms, not anonymous, but everyone can have access to this information. And there is a certain fee. This is a different transfer. The amount and the public address and the public address of the destination and the public address of the Bitcoin network. And the mining pool, we can use this the /pool.com, which is a platform that can be used for mining pool, and anyone can invest in ASIC technology, can use this platform to get Bitcoins and to get money. This is an investment that many people in the world is right now. Thank you very much for your time and for your attention. And right now I have a few minutes for questions and answers. Thank you. So no questions? There are no questions. So if there are no questions, no comments, we proceed for the second talk. We have the honor to have today with us Professor João Duque from Instituto Superior de Economia e Gestão. And the title of the talk is Cryptocurrencies or Crypto Assets, and I'm going to read his biography. João Duque was born in 1961 in Lisbon, where he lives. He has a degree in Organization and Business Management from ISEC, the University of Lisbon, and a PhD in Business Administration from the University of Manchester. He's a full professor and coordinator of the scientific area of finances at the Instituto Superior de Economia e Gestão. He coordinates the Master in Finances, where he teaches the courses units of derivatives and case studies in financial engineering. He is also the coordinator of the post-graduation program in financial analysis. He has published more than 2,000 entries as an author and co-author of books, book chapters, and articles in books and journals of a scientific nature. He's a member of the General and Supervisory Board of Caixa Central de Crédito Agrícola, Chairman of Remuneration Committee of Redes Energéticas Nacionais, SGPS, and belongs to the PC20 Steering Committee of Euronext Lisbon. In the past, he chaired the board of directors of a wide number of companies. He was a managing director of the research department of CMVM, Comissão de Mercado de Valores Mobiliários, between 1993 and 1995, and acted as advisor of Comissão de Mercados de Capitais de Angola between 2015 and 2016. He writes a weekly opinion column for Expresso newspaper, as a weekly radio broadcast economic analysis on Radio Renascença, within the daily show às 3 da manhã, and is a regular economic commentator on SIC Notícias Portuguese channel. João Duque, thank you very much for being with us. It's an honor to receiving you today with us, and the floor is yours. Thank you very much.
Good morning. Thank you for my introduction, quite long. What I'm going to talk, and I'd like to thank your invitation to be with you, thinking and discussing these subjects that are quite interesting and in the front edge in finance. And my question now is to be addressed is, what should we call to those crypto things? Should we call them currencies or assets? So I hope that now I'm sharing correctly my screen. So the first question is, when we talk about currencies, or cryptocurrencies or crypto assets, what we see is that is a huge step ahead in the development of money. And with the prices that are currently used to trade the main of these cryptocurrencies, let's call them for a while this way, it seems that the pandemic in terms of numbers are going along or like a fever. So everybody's buying. It seems that who is not buying is completely out of the world. And so everybody wants to have something about related with the cryptos. So let's take a step in this, because this will be the future. Yeah, we'll feel that the physical aspect of money is changed, but as I'll show you, money is not only cash or hard cash. And so we have digital money for a long time, although we don't use the same approach as we are using today to process or to produce those crypto assets. We actually live in a world that is already, in a financial world that is actually mainly digital. So in a sense, digitalized money is not anything new, but we have a new technology. And this was very well explained by my presenter. So when we talk about these assets and we see them in terms of prices, especially when we compare or we price them in dollars or euros, we are absolutely amazed, and we can choose the interest of people, in a lot of people, on these assets, from greed to, we can call them fool. Sometimes it depends on the perspective. Of course, for some, they are absolutely right, or some others choose absurd, mad, dippy, whatever. And it seems that actually we can have heaven and hell. So I have one statement made by someone that is saying something like this. First, I would like to say that anyone can have this kind of gains in crypto land. And no, I didn't mine any coins. And no, I wasn't an early adopter of Bitcoin, buying up coins when the price was under $1. I'm just a trader who fairly recently opened a few accounts and transferred $300 into my Bitcoin, then traded it up to $50,000. And there were so many great opportunities for everyone willing to pay attention to coin news, new coins, charts, and price sections. You can find out what's the hottest new coin and jump in early, steam it. You can track crypto news and see how the market reacts to bad and good news. You can earn or learn to read charts and prices action, which is my specialty. So this guy is very happy. I have another statement that says that I can't find the tweet now, but just the other day, I saw a guy posting about how he mortgages his car. So he just got a mortgage on his car, so lost it all trading cryptos, and his wife kicked him out. So, well, I don't know if for him it's a lucky or unlucky action, but anyway, he was looking to get it on a shitcoin pump, aka, where traders get together and buy like crazy to pump a penny stock equivalent to moon before dumping it on idiots. Not good. Do not be that guy. So this is the opposite, or he tells a story of very the opposite. Anyway, for a lot of people, we feel that when you talk about these things and that are based on technology, that come from other fields of science, we feel a bit in the darkness because this is relayed on blockchain technology. So I'm very glad to have a a presenter before myself that explained us what basically it is, how it works, and so it's a sophisticated mining process. But for something, it has, as we saw, a characteristic that is quite interesting. It's enable full tractability. And this could help to determine the original trade that justifies the crypto transference. And this is great. I mean, it's a paradise for regulators and tax authorities for the legal environment, you'd say. And so, in that sense, cryptocurrencies or crypto assets are a very interesting asset or product that comes out to be very helpful for those that work in the legal side of the economy. And it's great because it turns the world of those that hard work easier, because if more people pay the correct taxes, we can lower the tax burden to those that are now supporting this kind of burden, as well as turning society more fair. And this is quite important. But are they assets or currencies? So in a sense, I'd like to review the functions of money. And then you can classify those assets, or whatever it is, those digital entities, as being money, or be considered, or possibly considered money, so currencies or not. And so according to the theory, if they were currencies, they should fulfill functions of money. And those functions of money are mainly four. The first one is to be a medium of exchange, to be a standard of deferred payments, to be a measure of value, and to be a way to store wealth. So let's look at them and to see if what we have is accomplished those functions. So as medium of exchange, this means that that asset or that product should mean that two agents could settle a trade that we do on spot by exchanging that asset. So when we agree to buy, let's say, a kilo of bananas, and if the price is, let's say, €3, well, first I agree to buy. So when I go to the shop, I want 1 kilo of bananas. How much it is? Well, it's €3. So I agree and say, okay, I want to buy. And so the seller just give me the bananas. We are trading on spot because it's live and now, so not for a future delivery, it's from now on the spot. And then I kill the trade, let's call it kill. I settle the trade when I pay. So I do the financial transference, which can be made in hard cash, or I can just pick up my mobile nowadays and I use MBWay and I do the transference. And if I do a transference, I do it digitally because there is nothing. I see nothing. I see no papers, no documents, no signatures. My mobile reads my face and he sends it straight away to the another account. I believe, and he gets a message saying, okay, I got €3 and it's done. All right, so this is one very important function of money, is to settle trades that we do on spot. And so it replaced direct exchange. And this is very important. Otherwise, how can I buy bananas if I don't have anything that can be used to settle the trade? Could I, as a teacher of finance, it would be very hard for me. What can I teach the guy that is selling the bananas by €3? Is an advice? Is what can I do? So we have this way of exchange, which is very important. So this enables the specialization of functions in the society, and then we can use one piece of whatever it is to exchange by other things, and that can be used later on to re-exchange to another thing. So the seller of the bananas can buy, let's say, apples to someone else to sell them later on. And so as medium of exchange, we require that these assets must be easily divisible, which means we can split them up, let's say, an euro into let's say, 2 halves of 50 cents, or 10 tenths of 10 cents and so on. And they must have a high value relative to this weight. So I will not give a coin in pure gold, even if the face value is €1. I would not exchange that because the gold itself is more valuable than the coin. So when this happens, people do not use it as to exchange. So we need to have this production process that is lower than the face value of the coin. Otherwise, we keep the assets and we do not exchange it. So it must be difficult to counterfeit and must be readily acceptable. So we just issue and people accept it, and it welcomes the new coins. So and this means that not only people accept, it means that it has to have legal tender. It means that when coins or banknotes are issued with a bill, you can deliver that bill in order to exchange for physical assets, for instance. If you go to a shop in the US and you bring, let's say, imagine that the price is $6. Imagine that. Okay, and you don't have dollars and you have a bill of €5. And imagine that the corresponding price is the same, but you don't have dollars, you have euros. And you say, okay, so I'll give you a bill of €5 and I'll get the bananas. But the shopper will say, no, I do not accept euros. Okay, and you don't have the legal power to say, no, hold on. You have to give me the bananas against this bill of €5. That cannot happen in the US. But if you go into a shop in Europe, in the Eurozone, and if you want to buy €5 of bananas, and you say, I'm going to give you the bill of €5 and you will give me the bananas. And if the shopper says, no, I will not sell it to you because I don't accept euros, you say, hold on, my boy, you have to do it because euro has the legal tender. It's a power of exchanging. And if I'm going to a police station and I ask the police to come with me, the police will order him to deliver the bananas against the €5. And that's the legal tender. So it's quite important. You have the absolute right to exchange something for something. And this means that when you have a bill of $100, wherever you are in the world, you go to the US, and that's a contract that you have with the Federation of States of the United States of America. It's an agreement with you. The one that is in possession of that piece of paper has the right to claim whatever he wants that costs $100. And it's free. So it's like a contract between all the citizens of the Federation against the world or against their own citizens. That is, the owner of the bill has the right to claim whatever is under costs $100. And we don't have this except in two countries. One is very recent, is Central African Republic, as far as I know, and the other is El Salvador, that now is considered that their official legal tender money is Bitcoin. El Salvador also uses US dollars, so is the local currency, and as well as Bitcoin. But it's a very recent experiment, and it seems that the dream is fading already in El Salvador. So, and why? Because it seems that they did a very crazy thing, which was they are even buying for reserve Bitcoins. And so all the country now is depending, the support of the currency is partly based, okay, and the country partly based on Bitcoins. And this is a bit of crazy. And especially when you see that Bitcoin is not fixing the country's finances. And actually they are falling apart. They are having a serious problem. They had already the problem they increase the problem, buying hundreds of Bitcoins as a way to ensure some comfort of their capacities to pay their debts. And so, and based on ideas that I think that are absolutely crazy as this one, so it seems that they officially bought 21 Bitcoins based on an idea very simple, which is on the 21st day of the last month of the 21st year of the 21st century. This is a very scientific reason why to buy 21 Bitcoins. So this kind of steps will bring them absolutely down, and because they are just playing, in my perspective, with what they do not even know. I mean, if this is a reason, why not to buy 20 Bitcoins on the 20th day of the last month of the 20th year of the 20th century? Now, we can have any other reasons to buy whenever the date is. So, and this happens to be a very serious stuff, and they are entering into a very dangerous world, in my perspective, especially when playing with real currency and the way how the country has to survive facing real needs. So let's talk about the second reason why money is important in our society, and it's considered money, whatever is the asset, is the standard of deferred payment, which means that money is a way by which two agents settle a contract of credit. This is very important. When we borrow money, we borrow a certain amount of something. If I borrow 100,000 euros, I have to pay them back with some interest. And so my measure of deferred payment are euros. And if I do the agreement to pay them back in 10 years or in 10 years, at the end of 10 years, I have to come back with 100,000 euros plus the interest that was agreed. And this means that I cannot show up and say, oh, take a different currency. No. And the only way to do this is that the creditor has also confidence on the system that the value that is thinking to collect is considered to be compensated at least by the interest. And this is which means that you need stability, all right? And you need a certain stability against real assets that you can, or hours of work. Because when you borrow 100,000 or 200,000 euros, this means that in your system, you forecast to have to work X number of hours to pay your debt. Now imagine that amount is fluctuating strongly, which means that you borrow 100,000 euros, and if your hour is not paid in the same system, in the same unit, then you don't know how many hours you will have to work to pay your debt, because it can be 100,000 or 5,000 or maybe 1 million hours. You never know. It's crazy. So this function is really very important. And also it helps to play with the credit multiply coefficient, which is when money is created by deposits. This is what banks do. When you do a deposit, you are creating money. When they lend money, you are creating money. This is what banks do. So when they create money, when they concede credit, when they concede credit, they are depositing that money and they are creating money. And the way they create money is they multiply that money they create. And this is good because we can anticipate consumption and we can adjust the rhythms of consumption with the rhythm of life. Otherwise, no one could buy a house usually, unless in the last years of their lives. So you have to, for instance, you have to save all your life if you don't have credit. So if you have to save all your life and you get a flat, let's say in the last year of your life. So what's the purpose of that? So anticipating, let's say, consumption is it's the use of credit. And so as measure of value, it has to be used as universal unit of account, which means that everything has to be priced in the same system. This is very important. Otherwise, it's a nightmare of living. You know the experience when you go to countries where you have all the time to do the translations or transformations of how much is that if you go to a country that is different from the euros. You have to always to be calculating how much is in your value, in your money, in your reference. And if you have no reference, no common reference, it means that if I go to somewhere, I say, how much is the bananas? They ask me, well, how are you going to pay? Maybe I have chickens. Okay, so I want half a chicken for a kilo of banana. If you pay with, let's say, I don't have anything of this, so I may have potatoes, maybe 1 kilo of potatoes. So if you have to, if you don't have a reference, a common reference that is common and it's universal, you lose a lot of efficiency in the economy. It's a nightmare. So this is quite important. And the last function is the store of wealth, which means that you use money, especially when the inflation is small, to keep it as investment. And this is also important, although we have to keep in mind that money or currencies do not, if you keep them as they are in hard cash, they don't produce any income, they don't produce any dividends, they don't produce any interest. In order to do that, you have to save and to lend it. Either you do it through the system, the banking system, or you have to buy an asset that produces that income, but it's not the cash anymore. So if you talk about money, you have to make the money to be a part of the system in order to compensate. Otherwise, it suffers from not being producing any income, and it also suffers the risk of thief and fire. So in that sense, are cryptocurrencies, in my view, no, they are not currencies. Cryptos are not currencies because they not fulfill the 4 functions that are fulfilled for all the other currencies that are officially adopted by countries. And you know that since the most recent international agreement, we call them fiat money because it's absolutely fiduciary and absolutely dependent on an agreement that is made by the citizen of a country with the owners of the money that states that agreement. And I told you before, it's an agreement that tells you you can buy, you can exchange that for whatever you want in our constituency or region, because we have this agreement that will be fulfilled when you want to use your money. So in that sense, cryptos are not currencies because being accepted as they can be accepted as to use, but it's not. They don't have legal tender. They are not stable. So as I told you, if you borrow, let's say, bitcoins, if you borrow money in bitcoins to buy a flat, it could cost you the return could cost you half of that or the double of the or triple or whatever. We never know. So they let to being used as officially by all the by countries. We have those experiences in El Salvador, but as far as I know, and it is noticed by the news, the number of trades that are being done in El Salvador are very insignificant, and one of the reasons is price instability. So people are paid, or the reference is in another currency. So the number of hours that you have to work to buy a car or a flat is changing every time, and it's not changing slightly, or it's not changing, let's say, 2, 3, 5% in a year. Now it changes 50% in a couple of days, and it's a bit crazy. So, but can be used as store of wealth. Yes, they can be used as investment, they can be, but with no intrinsic value, we know. But it starts to be used as a fund, a source of funding, because now we have credit deposits that can be done in crypto assets, and this means that you can see them as not in that traditional way of deposit, but you lend the asset and you get the compensation, as we can do with shares. So if I lend a share, okay, I can lend a share, and the borrower pays me an interest. Is this money? No, it's a share. It's a share. If I am a shareholder of Tesla, I can lend the shares for a while, let's say a month, and they'll pay me, let's say 5% a month. So I get the same, I get interest, but the unit, the base of the credit and the debit is one share, and I have to be paid back one share, not the money, not the value of the share, but the share itself. And so it is the way it works, and that seems to be a very speculative. So as to show you, this gives an idea of how much is the price returns of measuring in dollars for the last year, let's say 2 years, 2.5 years. And as you see, for the last 142, well, this is more, yeah, 12 years, sorry. For 142 months, we got 80 months with positive returns, 62 months with null or negative returns, and the distribution is here. So we see that, yeah, there are a lot of months with a very strong positive compensations, but we also have a very significant number with very strong losses as well. So you can use them, and it's being used, I would say, more and more. They are being used more and more by new adopters, but in the sense as a speculative investment, as an investment, as you can do in gold or whatever, palladium or whatever. You can buy shares, you can buy whatever. So in a sense, they are very, they can be, you can, or one of the characteristics is tractability. So it helps you to know who is the owner or when it owned and why. So you can ask, why did you get that? And they seems to escape from the traditional fiat money and banking control. Yes, which is a lot of time is it's a dream for any transference, because now, in my perspective, it's not fast, but anyway, it's faster than sometimes the banking system used to do. But nowadays, in using MBWay is immediate and with no cost, apparent cost for me, because I can transfer money with the same simplicity and instantaneously. And in that sense, it's faster than using, in my best knowledge, using blockchain technology. But we can use secrecy in trading. So we have codes for our wallets, and if you don't give the code to anyone, no one will know who is trading. And there is no also guarantee of control, because those entities are not controlled, they're not supervised. And in that sense, there is an inconsistency between what is one of the characteristics and the use. So people, they say, yeah, they're very good because you are tractable, but if you don't say, if you don't release your codes, you cannot be caught. That's it. They seem to be very secure. This is very good as one of the characteristics. It's very difficult to elude the system. Maybe it's easier in the banking system, I don't know, but so they are very secure, and this is very good. And they seems to be to defend countries from money laundering and illicit activities, because they actually should or could be used to track the trades. However, the early and energy consumer, they take quite a time, in my perspective, to transfer. Although we know that in international transfers, this is a huge difference between using cryptos or using the banking system. But it's a question of technology, and the banking system can develop a technology to compete with those characteristics. And if there is a maximum number of coins, it's difficult to use this as a monetary instrument. And I'd like to stress this as one of the characteristics. It is without monetary policy and without the control of the volume of money in the economy, so money will not go along with the needs of economy. And one of the reasons why gold, the standard gold or gold standard was left was because we needed the gold, okay, to mine the gold to go along with the increase of the economy. Because the money, in order to have money helping society without inflation nor a scarcity of money, so in order to use money to go along the economy, we need to have some flexibility in issuing those cryptos. So there are some crypto assets that cannot be used at all, in my perspective, as units, because you lack a flexibility on that sense. And without monetary policy, we risk to lose control of inflation and price references. And it turns the world difficult to live and to manage. So it's why, in my perspective, so those coins, unless they are issued by central banks, they do not fulfill their characteristics, and they are, in my perspective, it's strongly advised not to adopt them as currencies, official currencies. You can use them as investment assets, but not to trade. Anyway, just because we are running out of time, I'd like to give you, let's say, an answer, a very quick answer to another issue here, which is, even being cryptos, investment assets, are they fulfilling one of the needs of those assets when we talk about market diversification and efficiency of investment? Well, I did two small experiments, but as I think that I'm a bit out of time, I'm going straight to the second one, which is, for me, the most significant. What I did with one of my students was to think that we are going to create portfolios with different assets. And let's see what happens if we create an efficient portfolio without a Bitcoin, for instance, and another portfolio, similar portfolio, with a Bitcoin. So let's compare what happened if we created a portfolio and we estimated the most efficient portfolio using without a Bitcoin, and then what happens if we introduce the Bitcoin. And so the idea was, okay, let's take several countries. So we would do investment in the US, in shares, and in shares in the UK, shares in Europe, in the Eurozone. So we used indices as proxies for those investments, and also in Asia, like using Hong Kong. So we also used in the US, let's say, the blue chip stocks that are mainly concentrated in the S&P 500, and as well as the new, most recent stocks with growth. Well, they tend to have a very high performance in terms of returns, based with innovation and technology, and they are concentrated in the Nasdaq composite index. So in the US, we had two different indices, plus, so let's say the Hong Kong, the UK, the Euro stocks, so the Eurozone, all shares. Then we had a component of one index that is composed of, let's say, the old traditional metals and metals that were used to store wealth, silver and gold. And then we also used VIX. VIX is an index of volatility. It's also a novelty in the market. So we created a portfolio based on those assets, and then we created them when we kept track between January 2012 and December 2019, so 8 years of investment, and then we saw what would be the result if we invest only on those assets when compared with an investment based on those assets plus the Bitcoin. And we use this in different ways, but basically this was the main, I'm going to show only one portion of the research. So this was the issue. And then we try to calculate the most efficient portfolios using the Sharpe ratio to maximize, and then with no constraints at all, plus, and I didn't bold it here, but we also tested, and I'm going to present the results when we applied a cap of 30% per asset, which means that in that sense, when you're looking for the most efficient portfolio, we would cap, let's say, impose a limit of 30% of percentage of investment in a certain portfolio or asset in a portfolio. So the Sharpe ratio is this one that relates the performance above the risk-free rate and the volatility of the portfolio. We use the German 10 years government bonds. All the prices were converted in euros because we live in euros, and this is the result. So we split up the sample in semesters, and so what we saw was calculating the most efficient portfolio with and without the Bitcoin, and to compare what's up with the Sharpe ratio. Well, the Sharpe ratio measures how efficient is the performance. If the Sharpe ratio is high, the performance is better. If the Sharpe ratio is low, the efficiency is lower. And what we hope is that when a new asset is incorporated in the portfolio, what we hope is that the return that it adds to the portfolio is more than the risk that is brought also to the portfolio. We know that Bitcoin is quite risky. So the question is the Bitcoin return compensating the risk of the introduction of Bitcoin, knowing that Bitcoin has a correlation with all the others, that maybe it could even reduce the volatility of the portfolio. So the question is that. And what happens? So the answer is here. Basically, what you see is that we don't have, well, if you read the differences, the columns with the differences, what we can conclude is that we don't have one single color as difference. And if the difference was always positive, we would see all the cells in green. If we had all the semesters with a negative impact of introduction of Bitcoin, so this would mean that Bitcoin would have a negative impact. What we see is it's a kind of a mix. Okay, so the number of semesters, roughly, the number of semesters where you have increases is a bit compensated by the number of semesters where we get the decreases. Although, as you see in the right column of differences, we have more greens than whites, than reds, but the sum is negative. And while the first column of differences coming from the left to the right, you have more negative than positives, but the difference is still negative in terms of Sharpe ratio. So the general conclusion is that, well, the overall result of including Bitcoin in portfolio is negative. If we talk with when we created portfolios with no constraints, or even if we kept them to 30%. But although negative, it's negligible because the size of the difference in the Sharpe ratio is not that big that could consider that Bitcoin is a disaster when we talk about diversification. So as a general conclusion, I'd say that cryptos cannot be called coins or currencies because they lack to fulfill the main characteristics. They don't create monetary supply and do not help in inflation control. So, but they can be considered digital assets. Yes. However, even though I have some difficulties to see the attraction of that because they do not offer a positive contribution. They have difficulties to show that they have effective, in the past, effective contribution to portfolio efficiency in order to be considered a very good asset. Anyway, the risks are enormous, as you know. And my final question is, why should one get rid of the power of creating money given to others that we don't even know, losing the risk of controlling money in inflation and to bring a lot of suffering to societies? Because I tell you, when we talk about inflation, and I lived in an inflation in my early years, when I started to buy a flat in the first time, I remember when interest rates were 18% or 20% and inflation rates were above 30, I remember the nightmare it was and how difficult was life. And inflation is really a nightmare, and we try to avoid it. And as a final remember is that ECB, the main objective of the European Central Bank is keeping inflation under control. They can, and you know that even though we have those strong price increases in the very recent 3-4 months, but if you look backwards, they have 20 years of history, and those 20 years they performed better than the Germans in the previous 20 years when doing the inflation control in their only country. Anyway, just to say a word, yes, in my perspective, they are assets. They can be assets as alternative investments. You are willing to use them, but you have to consider the risk and the impact in price efficiency. Okay, thank you.
Thank you very much, Professor João Duque, for a very useful talk. So the floor is with the audience, with the participants who can place questions or give comments, please. Well, maybe I have a question. It is known that there are advantages and disadvantages of fiat money and cryptocurrencies. There are always advantage and disadvantage, and I think eventually the future will be different right now, because right now we have observing an increase in the usage of cryptocurrencies with the time, along the time. So my question is, right now we have a value fluctuation of cryptocurrencies. What about the future? As the cryptocurrencies becomes more massive, its use becomes more massive, could we expect such value fluctuations less fluctuate. And what about the transparency and accountability? A second question, what about the transparency and accountability of the governments and of the banks? Do we have 100% transparency and accountability from the banks? And also about the money laundering. Lots of payments, illegal payments are implemented with bags of money, with cash. We know that the blockchain is visible, and the entrance or the inputs and outputs of money in exchanges are subject to identification. All of these identifications processes of the entities as the banks. So at least in Europe and the United States, this is necessary. These exchanges are obliged to identify the entrances, the inputs and outputs of money. So these are three questions that we know that we are in a transition period, and what is true today maybe is not true in the future, in 3 years, in 5 years from now. So yeah, that's my questions. Thank you.
Well, thank you. I had a slide with the questions, and some of your questions were addressed there still as questions. But in a sense, what we will have in the future, we don't know. But anyway, the feeling is that, or my feeling is that, the massive use of cryptos doesn't mean that people will accept them as, for instance, as unit of account or as unit of unit of deferred payments. I mean, when I borrow a share, I issue a contract, and in that contract, what tells me is that I have to return a share. When I rent a car, I write a contract, and the contract states that I have to return that car. Even worse, that car, not another car, it's that car, all right? So that's quite important. But these are very specific contracts. But in the vast majority of credit, we just issue a contract based on some account measure, and we don't have, even if you receive, let's say, digital money, we have to return digital money, and you don't care what are the bits and bytes. We don't see them, and we don't even have ledges or hashes or whatever. We just transfer money in digital way to another account, digital account. In that sense, this may be the future, and the future will be without hard cash. And that's my, I would say, only very clear future. In the future, we'll have no hard cash at all in order to avoid and to fight money laundering and terrorism's financing and illicit activities. This is, in my view, absolutely clear. So in that sense, we have to replace what we have now in our pockets, sometimes bills and coins, by digital ways of payments. Now, are they crypto assets issued by central banks or not? I don't know. The question is, why do we need them for? Why? We can ask banks to transfer money instantaneously. They can do it, and they can do it even internationally. All right? Okay. So as technology improves, this will reduce all the frictions that we actually have in nowadays to transfer money. But as I told you, MBWay is a system where I immediately transfer money from one account to another, in my region without costs or apparent costs. But now we have banks. So the question of issuing money and controlling money is a very serious stuff because inflation is related with the money. So one of the reasons why we are suffering now a very strong increase of the prices in a lot of countries is a result of the quantitative easing process that it took a long time, and now we are suffering this effect. But we had the benefit of issuing money when people were considering not spending because we were facing deflation, and in deflation people stop buying and can be a disaster in the economy. So in order to compensate that, what happened was central banks started to buy bonds issued by countries because it was a stimulus for countries to relax their budgets, and those relaxations brought activity and brought welfare to the economy. We do not want to face crises as in the 20s in the US, or even more recently when we saw the pandemic. We didn't react the same way because we learned a lot with the previous crises. So it's why we learn with experience when we implement treatments that try to overcome them. Of course, as every treatment has a side effect, and the side effect could be this one. Now, you add that side effect with other effects like supply chains interruptions, plus the war and so on. So we have a lot of effects that came simultaneously, and the prices just gone up too fast and too much regarding what they are expecting. But the money control is made controlling banks. When a bank lends you money, is creating money from nothing, all right? And they create, so they lend you money and they create money, right? Because then you have a deposit. And then you can, with that, you can buy whatever you want. Even if you deposit, and if I borrow that money that you have deposited, you got a debit card, and I also get a debit card for the same money. And that's amazing because we now could both shop around with the same apparent money. So, and this is the result of the credit multiplier. So banks, the only way to keep them within control is to relating the amount of capital they earn, all right, or they have against the total assets, the total credit they issue. So this is the way to control the amounts and the amount of money around, because too much money could create a lot of inflation. So in that sense, we need to have a control, specific control of banks. And this is done by someone who is supervised. And then again, the banking industry is so severely attacked by, let's call them attacked by supervisors that are central banks and banking authorities that create a lot of inefficiency in the system. And we have to pay those inefficiencies, as we have to pay the price of energy that is being used to mine those currencies, cryptocurrencies. We have to pay something. Now, we have to pay a system that ensures that things that can go wrong do not go wrong. And we have a system, a banking system, that is now more reliable, even although more costly than before. This I have no doubt about. Now, we still have to improve, yes. Now, final word about, I think, yeah, just to finalize, which is the massive use of those currencies will transform them in money. I don't think so. And the reason why is because you see what happens with shares. So we have thousands of different shares. We can state, even we could, let's say, now let's price everything in Tesla shares. So how much is one Tesla car is, whatever it is, You see, 100 shares. Okay, so let's price it. Are they heavily traded in the market? Yes. A lot of people have them in their portfolios. Yes. But we don't use them as units of account. We don't write contracts saying that, I'm going to pay you back, let's say 10 shares if you lend me money to buy a flat. No, it doesn't make any sense for us, because we know that shares, the price can fluctuate, and there is no control on that done by some independent body. And what we hope is that central bankers and regulators are, although independent from governments, but in a way we have a control in democracies, and this is quite important. We have a vote. Each one of us have a vote, and we vote in parties. Those parties elect MPs, members of parliament. Those members of parliament now approve those that are nominated to the central banks, the governing bodies. So in a way, we have a sense of some influence on those that are governing our currencies. Why should we abdicate this power to give it to someone that we don't even know in their interests? And some of them are pure private. As you remember, Facebook tried to issue currency. And why should I give that power away to someone that I don't even know? I don't know why, but anyway, that's my answer. Thank you.
Professor João Duque, it was a pleasure to thank you very much for having shared your knowledge with us and with this audience. It was a great pleasure to have you here on board today. Thank you very much. So we proceed to the next presentation. Nuno Almeida. Nuno Almeida from Ernst & Young. Nuno Almeida is a senior manager with 20 years experience in retail, digital-based business and complex projects leading in diverse contexts. He led business teams, large-scale operations and transformation initiatives with a lasting impact on business. Nuno has extensive experience in engaging various types of stakeholders in multiple geographies. He has also been a frequent speaker at industry-related events. Nuno has retail experience expanding along with different functions in the private and humanitarian sector, allowing him to have an all-encompassing understanding of the industry's value chain. So the next presentation, thank you very much, Nuno, for sharing your knowledge with and your experience with us. Thank you, Nuno. The floor is yours.
Thank you, Mario. Thank you a lot. Thanks for the invitation and also this opportunity to share with the audience some of the things that we have been doing over here at UI as being one of the leading companies in the world investing nowadays in blockchain. So let me share briefly my screen with you guys, and if anyone has questions, please gather them until the end. I'll try to answer them as best as I can. Just trying to, sorry, here. Here we go. Very well. So, first of all, a very short warning. I will be sharing with you guys some information on some of our products and services. And I will do it in a very upfront way. So just be warned on that. Mario already presented me. My background.
No, sorry, we have a problem of sound. Your sound is fading. So could you get closer to the microphone? Maybe this will solve the problem.
Okay, I'll try to do my best.
The sound is very
well.
A little bit. Yeah. Thank you. I think it's good.
It's good right now. Okay, great. So my background, it's in retail mainly. I'm quite a recent person in the consulting industry, and I try to bring to clients my experience on retail and more than 20 years in business. Over here in UI, we develop our solutions, having people at the center of what we do, and also always in the mind of the planet. And I bring to you guys this because this is key to the issue that we have over here and the challenge of bringing more transparency into value chains all over different industries. So we have to start on what are the behavioral drivers of consumers anywhere in the world. And first, we have to bear in mind that today's economy, it is possible because we have distanced consumers from the origin of the products that they are buying. So we have to rely on many different actors of the value chains of being trustful actors that will bring us to our tables, to our houses, products that are safe and they are what they say they are. Unfortunately, not always that happens. I'm not saying that when we were buying cabbages or milk or wine directly from the producer, there weren't any trust issues. There always was counterfeiting in the things that we buy, but the difference that we have from the past is that the distance that we have from the sources of the things that we buy makes that every event has a huge impact in the perception that we have on how much can we rely on the value chain. And this is a significant issue nowadays. Unfortunately, there isn't a lot or very frequent research on how significant this issue is, but there is some research on this, and OECD estimates that around 2.5% of world trade it is tempered by counterfeiting, which is a very significant number, naturally. And there are many different ways that products can be counterfeited or altered or even completely changed. If you look into FAO's research, there are 7 different ways on how this can be. The issue over here is not only, of course, that's the main question of safety in terms of if I'm buying something that is harmful to me, but whatever the situation that may have where this may happen, the main question is consumers are buying something that is less valuable than what was promised to them. And so building up trust in the transactions that all of us have, it is an important role in ensuring that today's economical systems work, and we still are able to trust the brands from which we are buying things, and we are able to develop and stimulate economic growth. And this is a very relevant issue for consumers worldwide. At UI, every quarter, we do a global survey on consumer behavior, And what behavior, what consumer tells us is that they like to buy fresh food, they value healthy products, they tell us that the sourcing of from where they are buying, it is very important. And also a significant part of consumers tells us that they are willing to pay a premium to buy products that are sustainable or services that are sustainable. So we, all of us as consumers, we value that we are buying good products. And they will bring us something good apart from their more direct nature. And we can cluster these behaviors, I would say, in three major blocks. Things around transparency, things about sustainability, as things also how we view society. I know that we are over here in an international environment, but nevertheless, since we have at hand Portugal, it is also one of the markets where we do this survey. I also sharing over here some numbers specifically for the Portuguese market. So one of the things that, well, several things that we are seeing today that are very important, and they all rely on trust, on us being able to trust on what we are buying from. So today, more and more consumers, they value brands that are transparent. Transparent, we have to trust that they are, in fact, transparent. They are one of the reasons they are not buying sometimes groceries online. It's because of the control they have on the products that they are buying. So again, transparency. Sustainability, it is more and more a very relevant issue, and all of us most certainly have heard about some situations of greenwashing that have been happening from time to time when brands and companies were not fulfilling what they were exactly selling to their customers in terms of what they were doing and how they were impacting the environment. And this is very relevant, especially during the last 3 years, because of the pandemic, the growth of sustainability as one of the key drivers of how and why we buy has been growing steadily worldwide, whatever the market. I know, and we just heard from Professor João Duque right before this, that inflation, it is an issue. And of course, this brings pressure on prices and what is the economical power of consumers. But even so, sustainability and environmental impact, it is something that is more and more relevant to consumers. The same thing in terms of society. More and more, we change our choices accordingly to what is the impact that companies will have, not only on the environment, but also in human society. So again, it's always an issue of trust. And so as a wrap, we can say that sustainability is more and more a driver for value creation. Consumers, they demand for companies to have an holistic view on how they are impacting the planet and also the society. They expect companies to be able to prove what they are saying that they have. This is an increasing driver of how to manage the value chain, and will have and has a positive impact in making the entire value chain behaves accordingly to what it says that does. And this requires us to redesign how things are operated. So how can we ensure that the value of what we buy? Well, all of us have seen probably some of the logos that I show you over here. And an important issue, I'm not challenging that these aren't relevant and important insurance mechanisms to tell consumers and tell the markets that what people are buying is authentic and it is accordingly to what the promise of the value proposition of each brand. Not at all. What I'm stating over here is that all of these mechanisms, they rely mainly on a centralized assurance mechanism. And especially a mechanism that it is based essentially on analog processes and also on processes that are usually then scrutinized in a sampled way. So not every transaction of a certain a Parmigiano cheese, it is certified that has been coming from specifically from the region where it's supposed to come from, or that every bottle of a certain biological juice was only made with products or with raw materials coming also from biological sources. So the flaw, lack of a better word, of these systems is that yes, they work, but they really rely on assurance mechanisms that by default have to look into samples, which of course usually happens, but or it usually works, but it's not a continuous and permanent way of ensuring that every single piece, it is what it is. And this is a challenge that happens in many different industries. We have the need in food and beverages for transparency and quality products. We all know, for example, a few years ago what happened with the powder milk scandal in China, which had significant health impacts in consumers, large populations. In retail, a significant issue, it is, of course, counterfeiting, happening many times that even in normal and very regulated value chains, there is always the possibility of counterfeited products may enter those value chains. And in other industries, there are also issues that will come around. For example, in logistics, a very relevant issue that we have over here is that all the paperwork that it is due nowadays to regulate most of the transactions that happened over there are paper-based or in a digital analog paper-based or paper-like process that makes that it is very effortless to be able to ensure that the entirety of the value chain is performing according to what was supposed to. So how can blockchain help in this? And most certainly it can help in this. So first of all, blockchain can help us to provide trust and transparency to the end consumer on what was the road until the product coming to his hands, and sharing with him the entirety of the information of the value chain, ensuring that that information was not tampered with. It also creates trust between the different actors of the value chain, because today this is a relevant issue, although there are, and of course that's a very good issue over here, there are standards that mediate transactions and facilitate the processes of pushing information when the transaction is moving along the value chain. But nevertheless, it is the interfaces, it is not, sometimes it creates challenges. So blockchain can help us having one piece of information that we can read, and we can see what was the complete road that product took. Create standards, as just I said it previously. It will fight, of course, counterfeiting, because it will expose the complete life cycle of a certain product. And as Mario Silva told us in the first presentation, the effort of not more than effort, the possibility of tampering with the blockchain itself, it is at this moment a problem that was not solved yet, and that is good news. And of course, it will also enable the consumers and opens the opportunity to have a more personalized experience and a better connection between the consumers and also the different actors of the value chain. So these 5 opportunities are open over here. So this is an example on how we approach today the transparency or the traceability throughout the blockchain. And what we do is that we start gathering information from the raw materials, and then ensure that along we go downstream on the value chain, all the different actors will tag in the same place what was their contribution to the transformation of the product. Many times when we discuss this with our customers and partners, this might seem something that is a lot of effort and work, because, oh, now we have to do this. Well, we do it already. And because if you, and especially in Europe, there isn't one single step over here that in some way I'm not obliged today to execute and to register. All the food safety and also other types of regulations in other industries apart from the food industry already demand in the European Union that every single step of the value chain, it is registered. We have to track over there what is the trace of the product that is being produced in some way. Even in very small scale operations, even in those small scale operations, this is something that is required. It might be flexible, it might be lighter, but nevertheless, it has to happen. So we are not demanding new steps, or we're not requiring new steps or new actions from the economic actors, but what we are doing is replacing the processes where we have the registration of information in different systems and in different solutions to all be logged in one single ledger of the product. What this ledger, this single ledger, enables us is automatic ability of neutralizing what we are doing. So in every single step of the value chain, being able to issue certificates, what is the trace of the product, or what is the origin of the product. We can use the tokens that are being created over here to diversify the way that we commercialize our products. We can also ensure that it is much easier and much more reliable, the traceability according to the value chain. And one example of this, it is the huge cost that, for example, when there is a problem with a product and we have to recall it, the effort today of recalling a product can go on millions, on millions of euros per recall. And this solution, or being relied on blockchain, will help us to lower those costs. And finally, because we are tracing every single item that we are managing in the value chain, it will also make much more efficient and much more effective. And over here, believe me, in inventory management, those two words are very, very, very important. All the process of the inventory management of goods. On top of or below all of this, there is also since all of this is happening in one string of information, it's much easier and much more possible to expose this information to whatever the actor in the value chain. Okay. What are the challenges that we see ahead? And one thing that's not over here, but it is extremely important, and it was referred by Professor Mário Silva, is that today's technologies are really in a very important moment of transformation. Most of the blockchain technologies today, they have a challenge of scale. They don't support a large scale of number of transactions that can happen simultaneously. This is changing, and this is changing very, 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 very rapidly. So today we are operating in thousands or tens of thousands, I would say hundreds of thousands, but for sure tens of thousands of simultaneous transactions. But this to have impact in physical value chains, for example, in food retail, we require to be able to manage this in the millions of tens of millions of simultaneous transactions. which is a very, very, very important challenge. So that's the first challenge that we are seeing that is happening right now, and it will enable a much wider and much more common use of these transactions. The second one, and this is related to sustainability, regulation is changing. I won't say not only regulation, I would say society demands also are changing in demanding companies to expose to them what is the entire impact of their products, not only on the raw material side, but even also after they were bought and consumed. And what the new platform or the new solutions for blockchain will enable us is also to incorporate that part of the value chain, ensuring that we truly have a full picture of what was the entire life cycle of a certain product. Of course, this will require not only a technological change, but also a behavioral change from all of us. Okay, coming almost to my time, I'll share with you two examples of application of this. They are both related on food. Apologies for that, but it's also due to my passion around food business. What we have applied these solutions to, it's to, I would say, very not only to staple food items, also pharmaceuticals, where of course the issue of trust and transparency on traceability of the product is very, very relevant, and also very important, it is luxury goods. Because of the unit value of whatever value of luxury good can be transacted, it is very prompt to be counterfeited. And also, of course, valuables are important over here. And also, e-commerce had a huge impact on this, because nowadays the distance that we have from the luxury good that, well, some people are able to buy, it's physically very far away. So we have to trust that small artisan that is doing his jewelry in some remote part of Argentina, it is in fact that person over there. What was the impact of what we of these use cases? And this is important to share over here, because it shows the value that is inherent in
Nuno, sorry, the sound is still fading, and we are running out of time. If you could help us.
I'm almost closing.
Speeding up a little bit your presentation. Thank you very much, Nuno. Thank you.
Very well. So one of the impacts, it has been the increase in sales, because consumers were trusting more on what they were buying, and also the ability to have margin growth due to the reliability of the nature of what they were buying from. So one of the examples that I have over here, it's on biological chickens in Italy. So one of our partners, a major retailer European retailer. They sell in their stores biological farmed chickens, and the issue is that, well, there was an issue of credibility on what was being sold. I'll show you briefly how this happens. Apologies that some of the text over here are in Italian, but I will show you. So the experience, it is very simple. When a customer goes to their stores throughout the country, they will pick up a package of this biological chicken, and they read a QR code that's on the package, and from that QR code they will engage in this website that you see over here, and the website will show the customer the total life cycle of that product. So it will tell the customer where the chicken was born, how it was fed, how much time it took to grow, all the entire life cycle of that product, and also enables, of course, for example, to show to the customers some recipes that they can use to buy the chickens. So, last example, and this one is for luxury goods. So this is a producer's wine, high-end wine, and this is not a physical use case. This is an e-commerce for almost fully digital use case. And once again, the experience is very much similar. What does over here is that whenever you log into the website, you can see the information of the product in the website very much in the same way that you saw previously. Of course, every bottle will have the QR code that enables the end customer to check that information it saw previously. It is exactly the same as the one that is reading now from the bottle. I'll pass the video if anyone of you afterwards wants to see it. I'll share it. With you. So, wrapping up. The macroeconomical trends are here. More and more Fortune big companies, or 500 or 1,000 companies, they are investing in this. The volume of transactions that are linked in some way to blockchain have been growing significantly in very recent years. The IT solutions that support blockchain are coming from expensive and inflexible to more flexible and less expensive. As in other technologies, and we take for granted many other technologies that now we think that they have instant success in the past, it's not the case at all. Usually technologies will take a couple of decades to be able to have some type of success. So I would say that blockchain is still in its infancy, probably at the end of its infancy, and now it will have the opportunity to grow. But most important thing to be really to enable the growth of this technology to supporting transparency, namely value chains. It's finding it's finding use cases that will be actually useful to end consumers. That will make the change for scale. Very well, just in time, 2 minutes late.
Thank you very much, Noon, for sharing with us your knowledge and experience. Thank you very much. So the floor is with the audience, with the participants, with any question that anyone may have. So I think there are no questions. We are already late with our program. So I think we have seen that blockchain technology is a child that was born and that is growing up very quickly. And we have seen with Nuno Almeida that there are these blockchain can be widely used to trace everything that is registered. So the keyword is traceability. That is the main advantage of the blockchain and will be used widely. And we have seen that some examples, namely in food industry. So thank you very much. So we now proceed to the next presentation. The next presentation is from Jonut Stojka, and the title of the talk is Law Enforcement Training on Cryptocurrencies. And I'm just going to read his biography. So Jonut Stojka is with CIPOL, is the head of Cybercrime Academy sector within the European Union Agency for Law Enforcement Training, CIPOL, being responsible for developing the necessary knowledge and the expertise on cybercrime in law enforcement authorities across Europe. Previously, he was involved in capacity building programs aiming at strengthening legislation and the institutional capacities on cybercrime, and senior project officer with Cybercrime Program Office of the Council of Europe, and also acted as head of the Department of Combating Online Frauds and Electronic Payments Frauds within the Romanian Police Central Cybercrime Unit, having more than 15 years experience in cybercrime field. Jonut holds a bachelor degree in law from the Police Academy, a bachelor degree in communication and public relations from National School of Political Studies and Administration, and a master's degree in international cooperation. So Jonut, the floor is yours. Thank you very much for being with us.
Thank you very much, Maria, for the introduction. I hope you can hear me well. Good afternoon, everyone. Thank you for the invitation. I am very pleased to be here. Let me just try to share my screen. Okay, I hope you can see my presentation in full screen mode. I know that we are running out of time, so I will try to be very brief. Today I will speak about education in cybercrime because training and education are important factors in the fight against cybercrime, and I will like to structure my presentation on 3 main pillars: training needs related to the new technologies, training activities we are implemented in CIPOL Cybercrime Academy, and the last pillar, it's related to financial aspects regarding cryptocurrency investigations. So very brief, CIPOL, it's the European Union Agency for Law Enforcement Training, and we are providing training activities for law enforcement officials across the European Union and to other framework partners on cybercrime, serious organized crime, counterterrorism, fundamental rights, and also on other thematic areas. But before providing training to law enforcement agencies, we need to be able to assess the training needs at operational and also at the strategic level. And in this regard, CIPOL is conducting different analyses regarding the training needs of the beneficiary countries. And I will refer only to the most recent analysis, which was published last month. And it's called the European Union Strategic Training Need Assessment. I can tell you that this document defines the strategic EU level training need priorities of law enforcement officials for the period 2022 to 2025, and it's identifying gaps in knowledge, skills, competencies, and related training needs. Also, this analysis creates a priority list of training needs, estimate the EU level training and information potential EU training providers so they can adapt and build their training portfolio. This document is available on CIPOL website. Anyone can download it. And we have different findings in different thematic areas, but I will refer only to cybercrime topics, meaning cyber attacks, online fraud schemes, and child sexual exploitation. And in each of these three areas, we have this component represented by cryptocurrency transactions. So it's important to be able to understand blockchain and how cryptocurrency transactions can be investigated. According to the inputs received from more than 80 different organizations consulted by CIPOL, cyber attacks topics moved to the first place in terms of training need, and also more training is needed on the use of new technologies, such as artificial intelligence, cryptocurrencies, blockchain analysis, and also in combating crime as a service methods used by the cyber criminal groups in illegal activities. If we refer to child sexual exploitation, child sexual offenders are problematic to be detected and prosecuted due to various factors. They often use fake identities, encryption, anonymous VPN services, proxy servers, and of course, dark web and cryptocurrencies. And if we refer to online fraud schemes, training it's also needed on different aspects on fraud schemes, on the modi operandi, and on effective investigation methods. Let's see what we can do in CIPOL as a training provider, because unfortunately we don't have enough resources to cover all these training needs on cybercrime, dark web, and cryptocurrencies. But the good news is that the first steps were done in 2019 when the CIPOL Cybercrime Academy was created, and it's implementing various types of trainings on cybercrime and also on electronic evidence. We have a strong cooperation with other EU agencies and also with other international organizations. Okay. CIPOL Cybercrime Academy, it's covering the entire spectrum of cybercrime, main areas of training, including here cyber attacks, online fraud schemes, and child sexual abuse and child sexual exploitation. In CIPOL, we are delivering online and on-site courses on dark web and cryptocurrencies. We have basic courses and advanced courses for law enforcement officials and also for judicial authorities, because it is extremely important from the law enforcement perspective to be able to understand how the transactions are confirmed on the blockchain, and to be able to find and prosecute the offenders in criminal investigations. It was very well explained by the other speakers that the blockchain technology has great benefits such as trust, security, transparency, and traceability of data shared across a business network, and delivers cost saving with the new efficiencies. Also, transactions in cryptocurrencies have many benefits, starting from transaction speed, reduced transaction costs, accessibility, security, transparency, and so on. In my personal opinion, crypto mass adoption, it's a matter of when, not if, and we can see that global cryptocurrency adoption, it's skyrocketing. All the analysis shows that residents of more and more countries around the world are taking the dive into cryptocurrency or seeing existing adoption increase. And according to the estimations for last year, we have more than 300 million crypto users worldwide, and over 18,000 businesses which are already accepting cryptocurrency payments. But there are also some risks and challenges associated with the use of cryptocurrencies, such as online money laundering, financing terrorism attacks, organized crime, and other crimes as well. So from the law enforcement perspective, it is extremely important, first of all, to understand the technology behind and to be able to follow the transactions in the crypto space and identify the beneficiary of these transactions when it was committed a crime. It was already discussed regarding Bitcoin as a legal tender. We have El Salvador and also African Republic, Central African Republic, who recently adopted a bill to make Bitcoin as a legal tender and legalized the use of cryptocurrencies. And in the same time, many other countries such as Cuba, Ukraine, Paraguay, Honduras, Guatemala are also analyzing this option. But on the other hand, International Monetary Fund has issued a warning on the adoption of cryptocurrencies, and it is against the adoption of Bitcoin as a legal tender, citing factors such as the high volatility, undermine consumer protection, ecological implications, internet accessibility, and so on. So basically, there are pros and cons regarding using cryptocurrency as a legal tender. Also, cryptocurrencies are a technical and financial innovation that offer major potential for the global economy, but at the same time, they are being used for criminal purposes, such as money laundering, fraud, online trade of illicit goods and services, and so on. So the ways criminals use cryptocurrencies, it's evolving and is spreading to all forms of serious and organized crime. For example, it is estimated that ransomware costs the world 20 billion US dollars only last year. And this number is expected to rise to 10 times more to 265 billion by 2031. And of course, all the payments, all the ransom payments are being made in cryptocurrencies. According to Chainalysis cryptocrime report published a few months ago, cryptocurrency-based crime hit a new all-time high in 2021, with illicit addresses receiving about 40 billion US dollars over the course of the year, up from 7.8 billion 1 year before. As we can see, most of the addresses receiving illicit funds are related with scams, stolen funds, darknet marketplaces, and ransomware. And the analysis refers only to addresses that have been attributed to individuals connected to cybercrime organization. So we can presume that those numbers don't tell the full story, because the attribution is generally hard to be made. But in the same time, transactions involving illicit addresses represent just a small percent of about 0.15 of the total cryptocurrency transaction volume last year. So only a small percent of all crypto transactions can be linked with crimes. Okay, let's discuss also a little bit about crypto challenges, and the biggest challenge for law enforcement is related with the anonymity and privacy provided by cryptocurrencies. Cryptocurrency transactions, as it was already explained before, are recorded on blockchain, which is generally public. At the same time, crypto transactions are not necessarily linked to an identity, which provides a bit of anonymity for users. So the transactions in Bitcoin and many other cryptocurrencies can be monitored in blockchain, but we have also another class of crypto known as privacy coins, created with the aim of masking the identity of users and details of the transactions. And we have probably on CoinMarketCap hundreds of privacy coins. We have here in this slide only the top 9 privacy coins by market cap, and Monero and Zcash are among the most popular, and the market cap for Monero it's about 3.2 billion US dollars, and for Zcash it's only 1.5 billion. Okay, and there are also many obfuscation techniques on the market, such as mixing and doubling, which aims to break the linkability and traceability of crypto transactions. So crypto mixing, it's not exactly like mixing music. The whole idea is that by shuffling Bitcoin through a black box, it's difficult to work out that person A sent 10 Bitcoins to person B. All Public Explorer will show it's that person A sent some Bitcoins to a mixer, as did a dozen of other people, and the other person, person B, received some Bitcoin from a mixer, as did also a dozen of other people. And there are also multiple tools used for mixing, such as CoinJoin, Samurai Wallet, and additionally, we have in-wallet swaps and decentralized exchanges, which make the job even harder to anonymize these transactions. Okay, this is just a short case study regarding the use of crypto for criminal activities. Probably you remember about the WannaCry ransomware campaign, because it was the biggest worldwide ransomware attack, with more than 200,000 victims in at least 150 countries, according to Europol. We can see in this slide in red dots the location of the victims. So there are victims from almost all the countries of the world, and ransomware encrypts the file and demands a ransom payment in Bitcoin to release them. We know that anyone can check Bitcoin transactions on the blockchain, so it was a huge interest at that time, not only by law enforcement, but also by journalists and other people, to find the beneficiary of these transactions, and in the same time to find the exit point from a fiat to crypto. But in many cyber attacks, and also in this case, we have the money laundering component, and I will try to explain each step of this slide. First, we have the malware. The computer, it's infected with malware, and victim gets the message to pay the ransom to recover access to his data. Of course, some of the victims choose to pay the ransom in the Bitcoin wallets specified by the attacker. Then we have the layering stage, where multiple transactions convert the payment from one virtual asset to another one, to remove all links to the beneficiary of the funds. And in WannaCry case, ransom funds were converted from Bitcoin to Monero using a virtual asset service provider, which didn't implement it at that point the KYC measures for transactions from one cryptocurrency to another. Having all the funds cleaned in Monero cryptocurrency, then the funds can be easily converted from crypto to fiat and invested in goods and services. So if we speak about transactions in cryptocurrencies, then we should take into consideration also the risks related to money laundering. How does money laundering work with cryptocurrency? According to an analysis from last year, 40 billion US dollars were detected last year associated with money laundering transactions. But in the same time, it is impossible to tell how much activity remained undetected. And a few words about cryptojacking. Cryptojacking, it's a type of cybercrime where criminals secretly uses victims' computing power to generate cryptocurrency. We have also malware installed in victims' computer, as it's the case for ransomware. But in cryptojacking cases, the only thing stolen it's the power of the victim's computer. And the type of cryptocurrency we see primarily mined on personal computers, compromised computers. it's Monero, and the reason for using Monero, it's pretty obvious. And of course, it's related with the anonymity offered by this cryptocurrency. And we have also crypto debit cards. Here we have just some examples. In reality, the biggest virtual asset service providers are offering these payment methods without the need to make the conversion from crypto to fiat before making the payment. So a crypto debit card connects a cryptocurrency payment processing company with your crypto wallet, and this type of card enables you to settle transactions at any merchant that accepts debit cards using the funds in your crypto wallet. So basically, you can use any merchant who accepts Visa or MasterCard. And a big difference between crypto debit card and traditional debit card. Crypto debit card automatically converts the crypto you'll be spending into the preferred fiat cryptocurrency. In the end, I want to say a few words about regulations, because the European Union has been making significant efforts to combat the money laundering through the anti-money laundering directives. Cryptocurrency exchanges and also custodian wallets are considered obliged entities and face the same AML regulations applied to financial institutions. Practically, this involves obligation to perform customer due diligence and submit suspicious activity reports. And also these directives also introduce regulation for providers of cryptocurrency exchanges and wallets, which must now be registered with the competent authorities in their domestic legislation. And in this regard, Binance, the biggest crypto exchanger in the world, announced last week, I think, that they become a fully regulated digital asset provider in France, just to be compliant with these EU regulations. And that's not all. Last month, European Parliament agreed to start negotiations within the EU countries on new rules that would allow tracing and identification of transfers of crypto assets to prevent their use in money laundering, terrorist financing, and in other crimes. So we should keep in mind that technology is the most rapidly developing area, and cyber criminals are often among the earliest adopters of new technology, and we should have always this balance between human rights and safeguards on one side and rule of law on the other side, in order to encourage the development and use of these technologies. The new rules aim to provide legal certainty, support innovation, protect customers and investors, and ensure also the financial stability. That's it from my side. Thank you very much. If there are any questions, I would be happy to answer.
Thank you very much, Jonut, for your view about and the CEPOL's view about the cryptocurrencies and their influences over crime, namely cybercrime. So now the floor is the participants. Any question? Well, we are already late, so in case there are no questions, Jan, thank you very much. There is a question, a general question that was sent through chat, but is a question for all of us, for the four speakers, and the question is: what are the factors that generate a bear market, and if there are differences with the stock market shares in this regard? So, from my view, I think cryptocurrencies are much more than stock market, than, let's say, the expectation or the advantage of the cryptocurrencies is to be used to trade, to buy and to sell, to exchange, not to since it started being used more and more, and we are experiencing an increase of usage of cryptocurrencies. Some investors started investing in cryptocurrencies, but this is not the main purpose of cryptocurrencies. This is not the main purpose of cryptocurrencies. So we should not view the cryptocurrencies as a simple investment share. It's completely different. Naturally, that the value of the cryptocurrency, from my point of view, increases as it becomes massively used. So I think the expectation is that it will. The fluctuation of its value will decrease as the world uses more and more. This is my view, but the future will give us the answer. I'm not the owner of the truth. This is my understanding. We have to wait. I don't know if the other colleagues have would like to comment on this question. So a link is being asked in the chat. A link for what? I don't know. It's not clear. A link for what? Okay. A link for YouTube. Okay. So this is being recorded, and the participants will have this on YouTube in case you want to have access to it. The link is already available. So I think in case there are no more questions, I'd like to thank the speakers initially for having shared their experience and knowledge with us and in making this effort to be present today. Thank you very much. It was a pleasure to be with you. And would like to thank all of the participants as well to be with us and to having placed your questions and your comments. So it was a great pleasure to be with you today, and look forward to see you again in the future, in any future event that we may have. Thank you. It was a pleasure to be with you. Thank you very much. Thank you. I'd like to thank also to ISCPSI, Instituto Superior de Ciências Policiais e de Segurança Interna, and to CEPOL also to have co-organized this event. Thank you very much. Thank you.
Our pleasure.
Thank you.